You would think with all the fear from the Fed and the fiscal cliffs around the debt ceiling, markets would be facing all sorts of turmoil, and yet FOMO is alive and well. We discussed this week. The Fed and the fiscal cliff or the debt ceiling debate continue to dominate headlines. And while there was some turbulence earlier this month, overall, the markets have been incredibly resilient, volatility incredibly low. The NASDAQ this week reached a point where it was up 20% year to date, hit a new 52-week high. The S&P is similarly near its highs for the year. And so how do we make sense of all this? Well, I think part of it is the markets looking at point number one, which is the credit markets, and saying, yeah, you know, it's not great, and it may be even deteriorating a little bit, but it's better than expected. And so I think, again, one overarching theme I want you to keep in mind, not as a solution to finding out an answer, but to embracing the humility of not trying to make a call, is even if you could figure out what was going to happen in the future, you also have to figure out what, if any of it, is priced into the market today and how the market would react to that. You put it all together, virtually mission impossible, but let's take a stab at least trying to explain what's moving markets today. First is the credit markets. So, as you can see, if you want to look at the written commentary this week, credit conditions continue to deteriorate, not only from all the Fed's hiking cycle, but then, of course, a lot of the banking turmoil, not unrelated to the former, that have manifested over the last few months. Depending on who you listen to, banking tightening is reaching 2020 type levels, and yet many believe the Fed thinks this still isn't even tight enough. And you saw a couple Fed governors this week come out and say, you know, more hikes may in fact be necessary. The second thing that obviously has dominated the news cycle and the market's attention is the impending debt ceiling. Earlier this week, markets rallied, and for the week in general, markets have rallied off a lot of positive signals and statements that a resolution was at least getting near, only to kind of fall apart this week with some comments to the fact that there's still real differences between the two sides, such that they're pausing talks right now until they can feel like the other side is ready to come back to the table. I think the important thing to know is we've been here before. As we talked about in last week's commentary, a ceiling is not the same as a default, but rather which bills are in fact going to get paid. And again, historically, these things do get figured out. I think an important point, again, that we enumerate a little bit more, touch on with a little bit more detail in the written commentary, is that this could be its own interesting phenomenon for markets to have to deal with post-resolution, in the sense that it's going to bring what some people are calling a deluge of new treasury issuance into the market that, again, could really be disruptive in its own way to liquidity. So, again, be careful what you wish for, I guess, is another way of putting it. Yes, we may get resolution at some point here soon, but even that may bring its own challenges for markets to have to address. Which kind of brings us to the ultimate question that all this really feeds into, which is the economy as a whole. Are we going to get a hard landing? Are we going to get a soft landing? Or as now pundits have come up with, are we going to get a no landing within the economy? Tom Essay, who we've quoted here before, took a look at three big data points: the ISM manufacturing PMI, the services PMI, and of course employment, to kind of look and deduce, at this point, probabilities are leaning a little bit more toward a soft landing, with the important caveat that when hard landings happen, they happen suddenly. Or as I've heard many people say, risk happens all at once. And so at this point, that's what's really driving a lot of the confusion, is that the data is not rolling over quite as hard as some people might expect. But again, I don't think that signals the all clear yet. He also went on to touch on the Home Depot earnings report, not only just interesting statement on housing and a lot of other conditions, but again, it did show, as some of the retail sales data did as well this week, that things are slowing down. Again, just not slowing to the point where things are collapsing, and that's the important distinguishing factor. Pulling it together, what does it mean if you are an investor? The NASDAQ hitting highs, all these fears, FOMO, fear. What it means is it may be again time to come back to dividend stocks. They've lagged this year after a relative, not necessarily absolute performance in 2022. But again, if we get into a slowing economic cycle, what we are seeing through the retail sales data is people prioritizing necessities and not necessarily some of their more discretionary type spending. That bodes well for some of those more cyclical sectors, staples types sectors within the economy that again, value stocks, dividend stock equation of the market. You couple that with some mean reversion, lagging year to date to things like the NASDAQ. That's a place where for a lot of investors, particularly those investors who are needing some income in their life, we'd encourage you to take a look. In short, rather than letting the politicians and the prognosticators continue to dominate your mind share, again, focus on process, focus on your own personal journey. If you need any help with that, we're here for you all the time. Thanks so much.